Right now, the U.S. is imposing sanctions. Sanctions it's a form of economic warfare, and it has a big implication for the dollar. Okay, now others are trying to get out of the dollar system. There's a dollar system that now is being changed. India is dealing directly with Russia, and holders of dollar-denominated assets don't want to hold those dollar assets if they feel that they're going to be grabbed and so on. So what's happening now has happened many times before. And I learned this in my past because in 1971, I was clerking on the floor of the New York Stock Exchange. And President Nixon gets on and he says, we're not going to give you the gold that the dollar is backed by. And we had a devaluation. It took me by surprise. I walked on the floor of the stock exchange. I thought it was going to go down a lot. It went up a lot. And that's because I never experienced the currency devaluation. I found the same exact thing when I studied history, same exact announcement took place on March 5th, 1933 by Roosevelt and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. If I didn't study that, what's happening now is very relevant. The past is a guide to what's happening now. As we are approaching a challenging of the world order, in other words, a great power challenging another, there is an increased likelihood of some kind of war. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. And those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases. It's not the stock market. Stock market, so it's, in the book, it takes you through the stock markets during war periods. And so the only thing that matters for stocks is the cash flows. And as you get into the conflict, that's a different story. If you begin to see as it progresses, those that are affected by the individual events have an effect, for example, tech stocks. But anyway, in answer to the question, how does it affect the markets? It affects the value of money, most fundamentally. Like what we're seeing now is that the value of money, when you run very large deficits, you have to spend a lot. You have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs and so on. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases. And then that devalues money. And so it's like the examples I gave you of the 2 currency devaluations that you had before. 1971 led to the inflationary period of the 1970s. And so you have the stock market. Yes, the stock market goes up and other things, but cash is trash. And people then begin to learn that the bonds that they're holding have negative returns. And it starts to change the value of money, the value of dollars and so on. So money goes into other assets. It produces more of an inflation, and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s. There's 2 ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And then how do you diversify? And the system also has to deal with what is money? Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies. We're seeing a variety. I think different types of money will compete with each other in the environment we're in. Maybe it's crypto, maybe it's gold, maybe it's other things. Maybe the digital renminbi competes with the US dollar. We're going to come into an environment. Think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that kind of a shift, I think, is very important. All currencies have a lot of debt. So when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency. But how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is and what the dollar is as a storehold of wealth. We're beginning a paradigm shift. A paradigm shift is a shift from a mindset and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, or having larger inventories, or homeowners don't worry about inflation as much in the purchases of their houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So for example, when there is the selling of bonds, that makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. Yeah, I'm concerned about that. When you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2% with an inflation rate which is considerably higher than that. We've had a 7% inflation rate, and we'll probably settle, it'll be a 5%-ish or something. And so you're still losing that money to inflation. People are. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. Here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult. And that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt and a lot of other debt, which one man's debts are another man's assets. And that as the holder of that assets is losing money. Imagine holding a bond now. Look at how much money is in bond funds and cash. Okay, not only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So are you going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment. So every investment is an exchange of a lump sum payment for a future cash flow. And so the cost of money is a consideration relative to the return on money. And so when we look at that return, when we say I can hold cash or I can hold a bond, that changes the inclination to hold cash. But also, one has to look at the expected return on equities. In other words, one calculates the present value of future cash flows. You estimate what are those earnings going to be in the future and what are they worth today. Stocks are now having expected returns, which are not very much more than bonds, which would be not very much more than cash. So as that happens, so that why should I own equities farther out, and have the volatility of equities? So that shift in the curve, in other words, the relationship between cash, bonds, and then the relationship between bonds and equities, and the relationship for corporations between the rates at which they borrow at and the rates at which they can earn money at, have a pervasive effect on the economy and the markets. So no, it's important to take a look at that relationship, that yield curve structured that way, but you should go beyond that and include the returns of other assets. What can you do in the way of generating returns relative to the costs of money, the relative attractiveness of those instruments? You have to have an economy in which the people believe that you have a fair system and you have to have productivity. So I would say the most important thing is the redistribution of opportunity to make people productive and to eliminate the internal conflict or to reduce the internal conflict, which can be so disruptive. When you see large wealth gaps and at the same time you see economic problems, you have a lot of internal conflict, and that internal conflict is bad economically and it's bad socially. But it's not just the wealth gap, it is the productivity level that results. And it's certainly going to be a political issue. So when we talk about markets and the economy and all of these things, we have to realize, for example, that internal conflict will have a big effect.